Welcome back to the channel. Today's video is especially important for anyone who depends on steady income from their investments, or anyone who's trying to prepare their portfolio for what could be a major shift in the market environment. We've had a powerful stock market rally this year. Returns are strong, headlines are optimistic, and technology stocks are once again stealing the spotlight. But while growth investors are celebrating, income-focused investors are asking a very different question. Where does this leave dividend investing? In this video, we're going to break down what's really happening with dividend funds, why they've struggled to keep up with the broader market, and why they may suddenly become much more important as we enter a potential new era of falling interest rates. We'll also take a deep dive into two well-known dividend ETFs, explain how they work, what makes them different, and which type of investor each one might be best suited for. This video is designed to be listened to from start to finish. No charts, no visuals, just clear explanations and practical insight you can actually use. So let's get into it. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. So far this year, the overall stock market has delivered impressive results. Including dividends, total returns have climbed beyond the 18% mark, which is a strong performance by any historical standard. However, that growth hasn't been evenly distributed. The rally has been overwhelmingly driven by fast-growing technology companies. Artificial intelligence, cloud computing, semiconductors, and software giants have absorbed most of the attention and most of the capital. This matters because dividend stocks operate very differently. Dividend-focused companies are designed to return cash to shareholders on a regular basis. They prioritize stability, predictable earnings, and consistent payouts. That makes them reliable but not always exciting during tech-driven bull markets. As a result, dividend funds have largely lagged behind the broader market this year, not because they're failing, but because they simply aren't built to outperform during speculative growth cycles. But that dynamic may soon change. One of the biggest factors shaping the investment landscape right now is monetary policy. According to federal funds traders, there's a very high probability, close to 90%, that the Federal Reserve will cut interest rates again this week. If that happens, it would represent the third rate cut of 2025. Importantly, markets aren't just expecting one cut. Traders are already pricing in additional rate reductions in 2026, signaling that we may be entering a prolonged low-rate environment once again. When interest rates fall, the consequences ripple through every asset class. Bond yields decline, Treasury income becomes less attractive, and high-interest savings accounts lose their appeal. Suddenly, investors who rely on income are forced to look elsewhere, and that's where dividend-paying stocks and ETFs come back into focus. In a low-rate environment, income becomes harder to find but more valuable than ever. Investments that can deliver reliable cash flow without requiring you to sell shares take on increased importance. Dividend-growing stocks in particular become essential tools for long-term investors. Dividends that increase over time can protect purchasing power against inflation, and even modest annual increases can compound into a powerful income stream over the years. While individual dividend stocks exist, not every investor wants to research and manage dozens of positions, which is where dividend ETFs shine. Today, we're focusing on two ETFs that already offer yields 2 to 3 times higher than the average S&P 500 company, while also providing diversification and built-in screening for quality. Let's start with one of the most popular dividend ETFs on the market, the Schwab U.S. Dividend Equity ETF, often referred to by its ticker symbol SCHD. This fund was launched in 2011, and its goal is simple but powerful: to track a group of companies with a proven history of consistently growing dividends. The fund follows the Dow Jones U.S. Dividend 100 Index, which selects 100 companies that have increased their dividends for at least 10 consecutive years. What makes SCHD stand out is that it doesn't just chase high yields. Instead of blindly selecting the highest-paying stocks, which can sometimes be financially unstable, the fund focuses on quality and sustainability. Companies are screened using multiple financial metrics, including cash flow relative to debt, return on equity, dividend yield, and 5-year dividend growth rate. This approach helps avoid value traps, which are companies that appear attractive because of high yields but are actually at risk of cutting payouts. The fund reviews its holdings regularly, and if a company cancels its dividend, it is removed from the portfolio. That discipline matters. Among SCHD's top holdings are some household names. Companies like Coca-Cola, Texas Instruments, and Avi all play major roles in the fund. These are businesses with strong brands, stable cash flows, and global reach. In 2025, each of these companies raised their dividends. Coca-Cola increased its payout by over 5%, Texas Instruments raised dividends by around 4%, and AbbVie delivered an increase above 5%. These increases may not seem dramatic, but context is everything. Inflation has been hovering around 3%, which means these dividend hikes are outpacing inflation, exactly what income investors want. When dividends grow faster than inflation year after year, income doesn't just stay stable, it grows in real terms. When you combine that growth with a strong starting yield, the long-term effect can be substantial. Right now, SCHD offers a yield of around 3.8%, which is more than 3 times the yield of the average S&P 500 stock. Since its launch in 2011, the fund has delivered an average annual return of just over 12%, which is impressive for a dividend-focused strategy. Even more attractive is its cost structure. SCHD's expense ratio sits at just 0.06%, significantly lower than the industry average, which means more of your returns stay in your pocket. For investors seeking dependable income, low fees, and dividend growth, SCHD has earned its reputation. Now let's move on to the second fund, the SPDR S&P Dividend ETF, known as SDY. This ETF takes a slightly different approach. Instead of requiring 10 years of dividend growth, SDY selects companies that have increased dividends for at least 20 consecutive years, which is a much longer track record. The fund tracks the S&P High Yield Dividend Aristocrats Index and weights its holdings based on yield. Since its inception in 2005, SDY has delivered an average annual return of about 8.6%. Its top holdings include companies like Verizon, Chevron, and Target, each of which raised dividends in 2025, though at more modest rates. So far this year, SDY has significantly underperformed the broader market. While the S&P 500 surged, SDY posted a much smaller gain. However, this underperformance isn't random. SDY has very limited exposure to technology stocks. Instead, its largest sector allocations include industrials, consumer staples, and utilities. These sectors tend to perform better during economic slowdowns or periods of uncertainty, but they often lag during tech-driven rallies. In other words, SDY isn't broken. It's simply positioned differently. That positioning could become an advantage if market leadership rotates away from high-growth technology stocks. One important distinction between SDY and SCHD is exposure to real estate investment trusts, or REITs. SDY includes REITs in its portfolio, while SCHD does not. REITs are companies that own or finance income-producing real estate, and they tend to benefit when interest rates fall. Lower borrowing costs and increased demand for yield often boost their appeal, and if rate cuts continue, this exposure could provide an additional tailwind for SDY going forward. SDY's expense ratio is higher at 0.35%. While that's above the ETF average, it's still below the average mutual fund fee. Its current yield is around 2.6%, which is more than double the S&P 500 average, but lower than SCHD's yield. Once again, this highlights the trade-off between yield, cost, and diversification. Choosing between these two funds depends on your goals. If you value higher current income, lower fees, and strong dividend growth, SCHD may be the better fit. If you prefer broader diversification, a longer dividend growth history, and exposure to R-rates and defensive sectors, SDY may align better with your strategy. Both funds offer above-average yields and the potential for rising income over time, especially in a falling rate environment. As interest rates decline, income investing becomes more challenging but also more important. Dividend ETFs provide a way to generate consistent cash flow while maintaining diversification and reducing single-stock risk. SCHD and SDY each bring something different to the table. Neither is perfect, but both are well-positioned to serve income investors navigating a new low-rate era. As always, it's essential to understand what you own, why you own it, and how it fits into your long-term plan. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.